All right, Edward Yardeni is with us, president of the Yardeni Research. Mr. Yardeni, thank you so much. Always a pleasure to speak with you here on NDTV Profit. Why don't you start by explaining to us and our viewers why the 30-year Treasury above the 5% mark is such a big deal?
Well, I think we are seeing around the world, there's some protesting going on in the bond markets to the amount of sovereign debt that is out there. And the United States, I think the big, beautiful bill that just passed the House still has to get through the Senate. But it's going to net add to the amount of debt over the next 10 years. And I think that's why you're seeing the 30-year bond over 5%. The 10-year is still fairly calm. It's still right around 4.5%. So we're not at this point looking at a real crisis or panic situation. But we certainly have to be concerned about the pressure that we're seeing in the bond market. The 20-year auction yesterday did not go off very well. And then, of course, the other area where there's concern about sovereign debt is in Japan, where we've seen 20, 30, 40-year bond yields go up rather dramatically in a very short period of time here. And it didn't help when the Prime Minister of Japan suggested that Japan's situation was comparable to Greece. I guess he was comparing it to Greece in 2010. Right now, Greece is doing actually very well compared to Japan, I guess, is the way I see it. But all in all, the U.S. economy remains resilient. Consumer spending looks like it's hanging in there quite well. The jobless claims that came out today suggest the labor market's doing quite well. And I'm not in the camp that thinks the dollar is going to take a dive here. I think the dollar is actually holding up pretty well on a trade-weighted basis. It's relative to the euro that it's been weak.
Okay. Hi, Dr. Yardeni. Thanks so much for joining us this morning.
Sure.
Term premiums going up. I'm just wondering at what point it will dissipate, because we've seen instances like this in the past several years where U.S. debt and the quantum of it has been a talking point, but that has dissipated. So do you see that happening this time as well? And at what point do you see markets going back to normal?
Well, that's a great question, and it's been sort of a question that's I've had to answer on a regular basis in my career. I've been doing this for over 45 years, and for over 45 years, there's been concerns that the debt crisis was imminent, that the sovereign debt would no longer be financeable, and so on and so forth. And that hasn't happened. So I've taken the position that I'll worry about the debt problem when the bond market worries about it. So I was concerned in 2023, we saw the bond yield go from 4 to 5% in a matter of 3 months, but then at 5%, there were plenty of buyers. And then we had on April 8th, in reaction to Trump's Liberation Day, we saw the bond yield jump from 4 to 4.5%, and the bond market got the president's attention, and he postponed the tariffs. So I'm watching. I'm not thinking that there's going to be a debt crisis in the United States, but there may be higher yields ahead here, which could start to threaten the resilience of the U.S. economy.
Dr. Yardeni, good evening to you. And
good evening.
Even if the dollar were not to weaken as much as the doomsday scenarios paint out, but if it does at the margin go down, if this bill sees the light of the day, so on and so forth, at the Senate too, what happens to flows in that regard? Because there's a lot of conversation out here in the emerging market pack, right? That if Japanese yields are moving up, if the US yields are inching higher, what happens to flows which are expected to move incrementally from the developed markets to the emerging market pack?
Yeah, well, look, there is certainly a case for a weaker dollar, and it's really become sort of the consensus view. And my contrarian instincts have kind of come out here. And I point out that the U.S. capital market, particularly our sovereign debt, our treasury bond market, is the largest in the world. Everybody keeps saying how big the bond market is, but people have been buying the bonds. Central banks have been buying the bonds. I don't see that people are panicking out of treasuries. And then whenever we get any sort of crisis in the world, money flows right back into the dollar and then into the bond market. And of course, we're looking at a world where stability is not one of the great factors that we can count on. The instability has been all too clear, and I think on balance that still benefits the U.S. dollar and the bond market. But I think the other point I would like to make is that a lot of people look at the dollar index, the so-called DXY index, and that's really a fixed weight index where 57% of it is the euro. So you're really basically looking at the euro dollar exchange rate. And I think if the euro keeps getting stronger, that's really bad news for Europe. Europe doesn't really need a strong currency right now. The US, if it has a strong dollar, can tolerate it, can put up with it. Our capital market could absorb lots of demand for our securities. So I think we still have that advantage. So I'm really not worried about the dollar taking a drubbing here.
What about emerging markets like India, Dr. Yardeni? In the midst of all of this, watching what's happening to the dollar, bond yields in the United States rising, does it spell bad news for emerging markets and India especially, which is now seeing a reversal of foreign flows after months of none of that happening?
Yeah, well, maybe India needs to file an application with the people who put together these stock market indexes and say, you know, we're different. India's stock market has been on fire. It's been very strong. There's a lot of optimism about the outlook for the Indian economy. The demography is much younger, more entrepreneurial as compared to other emerging markets, particularly compared to China. But also India, you know, other emerging markets like Brazil, Indonesia, they require commodity prices to be strong. That's in India's case, an environment where commodity prices are stable and relatively low, as they are now, benefits India more than most other emerging market economies. So the only problem with India is it's been discovered, and valuation multiples are high, elevated. But I think over time the earnings will justify them.
Okay. Dr. Yardeni, thanks so much for joining us this morning.
Thank
Always
you.
a pleasure speaking with you.
My pleasure.